Okay, the next question they ask is that, is it permitted to make capital contribution in kind? For instance, intangible assets or intangible assets, such as trademark, know-how, and expertise. If so, generally, what will be the legal process and time frame, etc., etc. Okay? So, here the question is, okay, you want to now establish a new company. Here's a foreign shareholder, there's a domestic shareholder. Now you want to establish joint venture company. But what about the capital? Cash is very simple. Each contribute cash. But can we contribute something other than cash? In kind, real estate. Okay? Some other assets. Can it be intellectual property? That is called in-kind contribution. Yeah, sure. In-kind contribution, possible. Possible. Okay? However, in Korea, it still requires a third-party valuation. It needs to be evaluated. Okay, so it needs to be valued by an independent appraiser firm, and it has to be submitted to the court for approval. So court kind of reviews. Okay, so because of the valuation and court approval process, usually takes some time. Could take about a month.
Is it also the case in the U.S. to take the appraisal to court?
No, no. In U.S., it's fairly simple.
Yeah.
You just whatever the shareholders agree, that's fine. But here, the Korea still has the system. I think it will eventually change, but it still holds that system.
I think it's based in German.
Yeah, German civil law, you know, so we are a civil law country, whereas US is the common law country. It's a little bit of a different system, but a lot of commercial code that we have, especially, you know, that it has a recent revisions in 2000, what, late 12 or, you know, huh?
11.
Yeah, but it was effective, I think, as of 2012. That practically got a lot of things from the US practices. But eventually it will converge, even though it's a different system to begin with, you know. I think I kind of see a convergence of these two. And it makes sense because, you know, through this internet and all this information system, there are a lot of convergences. Okay. So if it's more convenient system, it's easy to say we don't necessarily need such a complicated system. If it's better for the company to run without it, then, you know, why don't we go with that step? And that seems to be the trend. Anyway, it still needs to do so. But generally, okay, but that's a general rule, but there are, for small type of investment, okay, amount is less than Korean won 50 million and accounts for less than 20%. It's all in KCC, okay, 상법에 다 있어요. 20% of the company, or if it's a listed securities, obviously, if it's a listed securities, then its values are already there. And contributed at a price equal to or less than their market value. The contributing investor's monetary claim. If I have a claim, okay, I have a right to receive $50,000 from you. That's a monetary claim that I have, okay? and that claim is now due and payable, and then, you know, if that can be contributed, and the value, as long as the value does not exceed such in the value on that investor's book, that claim that is on that investor's book, then, you know, that would not be required. The court, you know, neither independent appraisal or, you know, court approval is required in that instances. And this is a KCC requirement, so you can go and read later on. Then they want to know what are the major requirements of the thin capitalization rules under Korean law. Have you ever heard about thin capitalization rule? Right? What's a thin capitalization? Meaning your capitalization is very thin, right? Meaning, okay, you know, you have very little capital and you have a lot of debt, right? The corporation is running itself under a lot of debt that you know, this capital, with this kind of thin capital, it's very dangerous. You go bankrupt. When it goes bankrupt, not only it hurts the shareholders, but it hurts all the creditors or counterparties of contract, or, you know, basically who have something to receive other creditors, right? So basically, Korean law imposes 3-to-1 debt to equity ratio, meaning that if you have a capital of let's say 1 billion Korean won, your debt, you know, maximum is 3 billion. Okay. And if that, okay, if that ratio is exceeded, the interest on excess borrowing may not be deducted by the Korean company.
Excuse me.
Yeah.
Is there any kind of legal, mandatory or voluntary reserve to be maintained by the company?
Oh yeah, there are legal reserves that needs to be maintained by the company. But if the company can do really bad and may not be able to fulfill it, then you are in a pretty in a sunken capital state, right? So this capitalization rule and the effect is that if you issue more than that, then you cannot, you know, the interest payment will not, you would not be able to deduct interest payment as expenses. Okay. So where do you get this kind of information? I think the easiest way to do it when this rule comes out is to type in the Google thin capitalization rule in Korea. Then it'll somehow lead you into a different types of thing, but I think it'll eventually lead you, it'll explain, okay? Here and there it'll explain, but there are a lot of like basic tax-related materials published by those big four, Deloitte, PwC, or KPMG, or Ernst & Young, that, for example, this is a document that readily comes up from the Google search. It's a Deloitte, published by Deloitte, Taxation and Investment in Korea 2013, right? And then, you know, it'll lead you into various types of basic taxation stuff, right? Setting up a business, different type of forms, then business taxation, the basics of the business taxation, withholding, indirect tax, taxes on individual, etc. It's a very good document to learn the basics about those 40 investments. It readily comes up. And if you just read it, you have much more knowledge about those basic knowledge about how things run than somebody who is approaching this without any knowledge. And that is basically, I use it all the time in order to check the information. I want to check the rate of the withholdings or, VAT or whatever that, then I check, because sometimes I don't memorize it all. I can't memorize it. So it's a good document to have. I have another one here. This is published by PwC. It's called Korea. Its title I forgot, but I think it's a kind of basic taxations related to M&As. And it gives you what the corporate tax rate is, right? What the value-added, tax rates, stamp tax, and other applicable taxes in M&A. It gives you the basic different type of entities here. That we talked about 주식 유한, and 함명, and 합자. And then yuan 책임, and then finally they have something called 합자 조합. Okay. Anyway. Wow, it's 8 o'clock. Okay. So time has passed. So my suggestion is, instead of taking a break, we just go for 20 more minutes, and right? I think that would be better. Okay. Because now I have a hard time covering. We are not moving along. What are the major statutory rights enjoyed by the shareholders holding 50% shares of the JV? What are the major statutory rights? Okay, that means you are controlling shareholder, and it's asking, hey, what's my right? Basically, you have the control of the company. Okay, if you have 50%, okay? So it's kind of hard to say there's statutory rights for more than 50%. Hey, you can go and vote, like all those shareholders, if you have the ordinary statutory requirement for the ordinary is majority of those present, and it has to be more than what? Quarter, okay, of the total. Now, if you have more than 50%, you can pass all those fundamental questions, including the directors. That means if you nominate directors, you can have management control, okay? So they will manage, okay, the company, basically what you have nominated. So it comes from that. What are the majority votes required for the ordinary resolution and special resolution of the shareholders meeting? Okay, we just went over that. Okay? What are the majority votes required for ordinary resolution and special resolution of the shareholders meeting and board meeting if applicable? It's a simple majority of the shares present at the shareholders meeting, which needs to be more than 1/4, at least 1/4 or more. Okay. A special resolution is 2/3, at least 2/3 of those present, and it has to be at least 1/3. Now, the important thing is that articles of incorporation can strengthen that requirement. Okay? It can strengthen that requirement, but it cannot dilute that requirement. Okay? So, for example, you can say if the ordinary is a majority of present, and it has to be more than 1/4 of the total issued shares. You could have a majority of present and instead of total 1/4, you can say majority too here. It has to be a majority of the whole. You can change that, all right? You can strengthen it. But there's a certain limitation of strengthening it, and the boundary is not so clear. For example, in the board resolution, usually it's a majority vote, right? Board resolution is majority vote. But if you say every board resolution must require consent of all members, in other words, if you strengthen it so far to make it unanimous, what it does is it gives any director a de facto veto right. Okay? Because if he says no, no board resolution can be passed. Right? It gives that kind of power to a director, and it is likely to be held invalid under Korean law. Right? That how much strengthening is valid and how much it is invalid. There is no clear line. You just have to go through, and find out. Go through those exercises. You look at different, the scholarly commentaries on that law. And, even if it's a court decision, if it could be a lower court decision. If it's a Supreme Court, that's it. Okay, there's, that is the rule. But if it's a lower court, it might change. But still, you need to take into account of how far you can strengthen that. But that's a legal, scholarly matters. So we usually say you can strengthen it. I don't see any problem of making this a majority 1/3 to the majority. But I don't know, if it goes 100% or something of that sort. Okay. So if you strengthen that requirement, you are actually giving a veto right to the minority shareholder. Right? So why would a majority shareholder agree, if that is the case? Anyway, 50-50, okay, 50-50 joint venture, nobody has the control. Right? So here, it doesn't matter. You can, instead of a majority, you can say 60% or 70% of those present. Just to make sure, right? But anyway, that's how it goes. As for the board, okay, a majority of the directors has to be present in order for that meeting to be validly held, okay? And then, again, it's the majority of the directors who are present at the meeting, right? So if there's a 4-member board, in order for the board meeting to be held, you need at least 3 present, right? And the majority of, if only 3 is present, the majority is 2, right? In this case, with these 2 guys agreeing, you can pass a board resolution. Okay? So this is the question. Since under Korean law, a directors cannot be a corporation for 주식회사, right? You cannot be a corporation. So, what would you do? Would you kind of say, okay, board resolution, majority of presence meets the quorum, and then majority of that votes? Then you can think about this option is, okay, I nominate 2, but happen to be this guy became very sick or disappeared. He went to a vacation and suddenly not, we don't contact, all right? So only one guy can be present from our side. Only one guy. Okay? In that situation, the other party, by being present, can pass the thing, right? Because, why? Because the board member has to be a person, right? we cannot delegate it to somebody else like shareholders. Shareholders, you can be present by proxy. Basically, it's a right. The reason is that the shareholders, it's their right to participate and vote whatever they want to. It's not an obligation. However, for directors, you have a duty. You have various duties. You know, duties to be loyal, duties to be, you know, when somebody is appointed by shareholders, shareholders specifically appointed you to manage it. You cannot delegate it to somebody, the management authorities, right? So I cannot give, if I'm a director, I cannot give you to attend, you know, and vote as a director. No, you must be a person, right? So that is the reason why it used to be under Korean law, there must be a physical meeting before, okay? There has to be a physical meeting, right? It was then relaxed a little bit. Hey, come on, we can participate nowadays, you know, without me just going there and physically seeing you. So they changed it to something that video conferencing is allowed. Simultaneously can see your face and hear your voice, okay? Now it's further relaxed, so that you don't need no video conference. As long as you can hear simultaneously what each other is saying, teleconferencing is sufficient. So it made it much easier, especially in this international environment where do they have to fly all the way from outside to be here all the time to convene? No, you can just do it. You don't even need Skype. You can just do it through a telephone conference, right? So the trend is to make it easier for that attendance, to meet that attendance. But still, this guy could be missing. This guy could be do what, right? So in order to make sure in this type of equal representation, you obviously want to strengthen, right? So if you say, okay, whatever, the majority needs, but you need, let's say, 3/4 of the total number of directors in order to pass a resolution. If you have this, right, even if nobody gets here, then obviously no resolution can be passed. If only 1 of 10, this guy must agree. If he doesn't agree, this 2 is not enough, right? So obviously you have an incentive to strengthen this requirement. One of the things that always comes up in this question of 50-50 is the deadlock. It's a deadlock situation. What if the board, they want to do something, and so there's an agenda came up and say, hey, we need to go to now Vietnam and create a subsidiary out there. That's a good business. And people disagree. You and I disagree. The board resolution does not pass. Next time it came up, it does not pass. Okay? That means no subsidiary, in there. But when those, disagreement continues, and then it becomes a deadlock, the business cannot move forward, and people need to think about what happens when this deadlock happens. So in joint venture scheme, the deadlock and deadlock resolution mechanism is very important, right? So how they usually approach this question is, you have a deadlock where the board cannot, resolve it. Then there's a second time the board cannot resolve it. Then they refer it to the shareholders, right? And shareholders, there's an escalation from fairly high-ranking officers, and then afterwards, really high-ranking officers need to meet and discuss. When it goes all the way in a big company, when it goes all the way like to the really, really top people, they are really pressured. in order to think about it. Okay, he needs to go to Lee Jae-yong and what? I have to go and now I have to discuss this? Okay, at their level, it's kind of maybe easier to reach a resolution. So that's how they usually do it. The escalation step, you go all the way to the possibly the top, whoever that they can meet. If they cannot do it, top guys don't agree or cannot agree, then okay, this is it. We cannot continue. Then it goes to the termination and dissolution and things of that nature. Because deadlock, think about it, it's not a breach. You have a joint venture agreement, and usually if there is a breach, and if that breach is material, and the other guy do not cure the breach, then obviously the other partner can terminate, right? And then terminate. It's due to your fault. I'm terminating, so I have to get some right, meaning that I can either sell my shares to you. I can force you to sell my shares at, let's say, 120% of the fair market value. You have to purchase, okay, above fair market value, or I will purchase your shares below fair market, like 80%, right? So you have those default, because you can liquidate the thing and forget it. But if one guy wants to run it, or I am making you, I just want to exit, okay? I'm going to exit, okay? If I decide to exit, I have a choice. I can either run it or exit. Since you are the wrongdoer, I make you pay for it. Yeah.
Do we call that put option or call option?
Yeah, you can call it default put option or default call option. Exactly. Yeah. So that's how it goes. So both of them can be strengthened. However, for the board, it is not allowed to have unanimous. But how far they can go is still unclear. Okay, what are the important matters of the JB requiring special resolution as required under Korean law? Well, obviously, you can research this. Matters that requires a special resolution under Korean law, and then you type it in Google, it'll lead you to somewhere. It gives you a very nice view of what matters are required. Obviously, those information, be sure that they are not absolute. You don't know whether they are current information. You always need to check the date, and whoever published this information. If the publisher of the information is somebody you can depend on, you could, but you just from those kind of comparison of available information, you get the general knowledge. But ultimately, the thing you need to go through the verification process. But it's out there. Anyway, special resolution for the shareholders. It's amendment of articles, dismissal of a director or statutory director, merger. Okay, I say it's something fundamental. Okay, shareholders' resolutions. Especially it requires a special supermajority vote, then it's something very fundamental. Amendment of article, dismissal of director or statutory auditor, appointment is by ordinary, okay? Merger with another company, obviously it's a fundamental corporate change. Dissolution is another fundamental corporate change. When you want to reduce your capital, 감자, okay? That's a fundamental change. Or if you want to purchase and cancel shares, the company can purchase the shares and cancel it, right, for the purpose of cancellation. Or if you want to transfer a or important part of a business, that requires a special resolution of shareholders too. So these are all in KCC. And I don't know what bar exam is like, but if it's on KCC, it's good to know. It's very useful. And knowledge, whether you be in-house, you gotta know these things, right?
I have a question.
Yeah.
If canceling share, does it mean 주식 소각?
Yeah. Yeah. Once you buy it, it becomes a treasury share, right? You put it in your treasury and you cancel it, right? Sometimes for like listed companies, you can purchase shares just to control the kind of market price, yeah, to allow them up to a certain extent. What about the matters requiring a special resolution of the board? Yeah, those are generally deals with self-dealings. For directors, it's about self-dealings. Meaning that director wants to enter into some kind of transaction with the company, then you have to, the amended KCC requires you to kind of get a special approval, of the director for that. You have to disclose that matter first, because it's self-dealing. Also, if the company wants to enter into a deal with the shareholder, okay, if it's a 대주주, then it also needs to get a board of directors special resolution. Okay. Does the board of the JV need to have a minimum number of directors? I answered this question, right? If your paid-in capital is below 1 billion, yeah, you can have one or two. What are other senior officers, such as the company secretary, CEO, in-house auditor, etc., for the JV as prescribed under law, and what are their major roles and responsibilities? Yeah, there's no company secretary in Korea, okay? CEO is not a legal title, okay? It's the representative director, okay? And he has the power to legally represent and bind the company, and responsible for implementation of the resolution of the board of directors and shareholders. He needs to implement, okay? So, and he manages the ordinary day-to-day activities. They can, statute only recognizes two types of things, okay? Officers. Representative director and statutory auditor, other than directors, okay? What's the role of statutory auditor? That's a question commonly asked. What's the role of statutory auditor? What is the role of the 감사?
He has to control the financial statements.
Yeah. He has to, right? He can review the financial statement, right? Yeah. But the main role of statutory director, there are several roles, but one of the main roles is to, obviously, you want to audit what? Outside auditors audit financial statement, but the statutory auditors is one of the main function is to, yeah?
Provide information to the shareholders?
Yeah, right. But it monitors directors, right? So obviously making sure that director exercises their, properly functioning their duties as a director, right? Directors have fiduciary duties. The fiduciary duties are duty of loyalty and duty of care and things of that sort. Duty of loyalty means you have to put forth the company's interest, right? So you have to work for the company's best interest, not your self-interest. And then duty of care is that you have to put proper care into the management. You cannot neglect, you know. The board members should know, understand what is going on with the company. And when you make a decision, you have to form a decision based on properly informed decision. You have to make an informed decision. You don't have to be an expert in all the areas, and you won't be. But you can ask for expert opinion. You can take the opinions, you know, in order to make the proper business judgment. If you didn't do that, obviously you are not held responsible. But if your business decision goes sour, right? But directors can become personally liable, okay, when they are found to have neglected their duties. Who can sue? Who can sue the directors when they have neglected their duties?
company.
Yeah, company, but company is controlled by directors, right? So there is such a thing called shareholders' derivative suit. Because the company is controlled by director, it will be practically very hard for the company to sue. So I will sue on behalf of the company. Okay, that is called shareholders' derivative suit. All right. Okay. So their role is to monitor whether directors are discharging their duties properly. They also have the power to investigate the financial conditions of the company and audit whether the financial statements are prepared. That's what Philip just said, and maintained in appropriate manner. So a right to monitor, a duty to monitor means they have a right to attend the board meeting. Though they are not the decision maker, they can attend the board meeting, okay, to learn what's going on. That's why when you give a board of directors meeting notice to the board of directors, you should also notify the statutory director of upcoming, okay, right? And it can go and express its opinion. Hey, I don't think this is done properly. This is my opinion. You can express your opinion, but obviously, you know, you are not. He's not running. The statutory director is not running or managing the company. He's just checking, okay, whether you are. It's a system of check and balances, right, which is necessary. So therefore, obviously, this is system of check and balances. Can a director also be a statutory auditor? No, you can't, because it's like self-checking. If I am the statutory auditor, I am checking whether I am performing my duties correctly. And obviously that is the reason why as you go up and become a public company, you have more kind of duties to now various types of shareholders who are just investors who doesn't really function. He doesn't have control. He just makes the ordinary people makes investment for the ordinary stuff, you know. So that is the reason why the roles of statutory auditor is getting strengthened. And the way of strengthening is that the statutory auditor is not related. It's not, you know, it's an outside, independent of the company. Okay, obviously. You know, I can be a director, I can work for the company for 24 hours. Obviously, I'm pressured to kind of satisfy whoever really, you know, it's hard to say no, you know, whereas if you are independent, you have a, you know, kind of better stance, right? But however, even if those independent directors, when they get paid, they tend to kind of go along with what the management wants, actually. That's the reality, right? That's why there is a kind of sanctions against, you know, breaching the duty. So that's why having a director position is not necessarily be happy, go happy thing. It's not some kind of a royal position where you can only enjoy your benefits. You know, it comes with responsibilities. All right. Are there any statutory qualifications required for directors and senior officers? No, nothing particular. Other than, you know, independent outside director. But you could, in the Articles of Incorporation, you can prescribe the qualification of an officer if you want to. And then, obviously, once it is written in the Articles of Incorporation, that's a fundamental constitutional document, so you have to follow, right? Does there need to be a majority of local residents? No, there's no need. Directors can be 40, all of them can be a 40 residents, actually. There's no requirement for them to be a local resident. Does directors require local tax numbers? No. Local registration? No. Yeah, local registration, yes. They need to be registered with the court registry office, right? Their names. Okay, could a corporate other than an individual be appointed as a director? No. Under Korean law, it has to be natural person. Directors need to be natural persons. Company secretary, we don't have company secretary. What's the internal procedure required for appointment and nomination, removal, replacement of directors and senior officers? Okay, statutory officers, meaning directors and statutory auditors, appointed by ordinary resolution at a shareholders meeting. Are these appointed by ordinary resolution of a board meeting? However, removal requires a special. Okay, removal of these individuals, the statutory auditor and director, requires a special. Removal of an RD does not require any special something of the board. No, board can just remove it, you know, with ordinary resolution. The non-statutory officer, it's not statutory, so CFO, okay, for example, is a fairly high position. The law says nothing about it. It's up to the JV partners to decide what to do. You know, obviously, if you can go with this joint system, but it's often difficult. If this guy appointed by Korean shareholder is a resident, obviously, so he would be full-time, but this guy then means he needs to be here full-time. Otherwise, it's very difficult. If he reside outside and become a joint director, then you need two representative directors seal in order to enter into anything, right? It's very difficult if this system is practically difficult. So another system that is commonly done is one appoints RD and the other appoints a CFO. Meaning this guy controls the finances and money of the company, right? What can this guy do without money, right? So if you appoint local guy, if you appoint RD, I'm going to appoint CFO. Obviously, in that sense, then the joint venture agreement must say how and who will appoint CFO. It will be by the board, you know. The joint venture agreement would say, okay, RD would be this, would be nominated by the Korean party. It can go alternate. Next year, we appoint our RD. You know, the next term you appoint. So CFO could go alternate like that. I have seen this too. or just, you know, okay, I trust you. I think you guys know how to do the management of a Korean company. I just appoint CFO and control money. You know, in that sense, then CFO needs to be appointed by the board. So as the important manager, the important directors, not statutory directors, but those officers, executive officers, if you are good at like marketing, you know, there are sales, marketing, there's a technology, and you know, other stuff, right? Then if these are important, then you also say something about how to nominate this, who has the right to nominate these guys, you know. I said nominate, and then appointment is done by the board. But you have to cause the director, you have to nominate to vote for that person or something. That is what the joint venture agreement will say. Joint venture agreement will say all these things, like what are the items that needs to be approved by the shareholders, what are the items that needs to be approved by the board meeting. Usually it is clear if you give monetary threshold, okay? Any expenditure over this amount, okay? Any disposal of assets, okay? Any like getting a loan above some certain amount, you know, things of that sort requires a board of approval, and if it requires more, then it requires shareholders approval, things of that sort, right? Also, if that is, you can have that layers, shareholders, board, and then you have something else underneath before going to RD. So you have different layers based on monetary, you know, because board cannot, it's difficult to convene a full board meeting. You just say 2 members of the executive committee, we set up an executive committee, and lesser amount needs to be determined by these 2 guys, for example. And then even lesser amount can be determined by RD. Anything above 1억 to 5억 maybe, right? Needs to be decided by this guy or something of that. So you can have these different layers. It all needs to be set out in the joint venture agreement, because we don't need no other things here. It's basically the shareholder agreement part, because we skipped all those share purchase and reps and warranties and all other things. Okay? Oh, things passed. I think we can stop here and continue next lecture. Okay. Thank you.